Welcome to this yet another podcast with Mahavir ji. Mahavir Sharma ji is one of the illustrious investors from the state of Rajasthan. Now, traditionally, I myself was surprised when I came across Sir's profile that Rajasthan and then angel investing, VC funds, CAT AIFs somehow it's not the most frequent thing because you kind of think of a Bangalore, a Delhi, a Mumbai when it comes to angel investing and a VC and a CAT AIF. But Sir has really been at the forefront of investing in Rajasthan. He's been the founder behind Rajasthan Angels and runs his own fund, Swishin, which is a VC fund now, will also launch itself as a Cat 1 SEBI registered fund. So AIF. So, sir, if you can just briefly tell us about your journey so far, and that will be very helpful.
So basically, I started as any other general entrepreneur in the handicraft and jewelry sector. We were into carpets and jewelry, and business was going fine. And then, we realized in 2009-10 that technology will be playing a very important role uh, going forward. And obviously, you can't turn back time and go to colleges and become a techie yourself. So the best thing to do was to angel invest in technology-based companies and to learn from them. So in 2011-12, we started Rajasthan Angels. I started to invest very small amounts of money. Eventually, it became a passion. It became something that was exciting, something that I enjoyed learning when I was being pitched by startups. And of course, you made money on the go, and we had a few very good exits, and we continue to grow in the invested company. So I think it helped me launch. Of course, TIE has been an integral part of it. The conversion of a business entrepreneur to tech angel investor is because of people that I had met on TIE platforms, and I was inspired by what they had done. So quite honestly, it's been a very good journey, transformation from being an entrepreneur to being now a tech investor, angel and VC has been very fruitful, exciting, and learning to say the least.
And sir, Rajasthan at the forefront of this, do you face any challenges when it comes to as a location as compared to, let's say, you being in Mumbai, Bangalore,
So,
or Delhi?
yeah, the for startups, it was a problem, because getting the right kind of technology based team was a challenge. But quite honestly, COVID made us all realize that it doesn't matter where you're sitting. People came back to their hometowns from Bangalore, Bombay's, and in the US to stay put with their families, and still they were able to work over video conferencing. So I think people realized that the technology could be sitting anywhere. Sales and marketing could be sitting anywhere. The headquarters could be third place. So I think that has transformed, and now HR is not a problem. Jaipur has quite a few advantages, and I've always been harping about that. Our quality of life, our cost of living, our commute, reach out to cities in India, whether through train or plane or whatever, and the world is not very difficult. So I think Jaipur has great advantages, and we are making use of it. Excuse me. Yeah.
So my larger question is this is like a investing masterclass. So what is your whole approach to investing? Let's say in a tech startup, if it comes to you, you would be receiving, let's say, hundreds of decks every month. So what are your primary filters in terms of your screening capability criteria and then the capabilities of the founders? What exactly are the things that you look at before you even decide to go for some sort of a detailed deep dive
So
into?
obviously, the first thing that we look at is the sector. Is the sector acceptable to us? Obviously, if it's a very crowded domain, if it's a very very competitive area, if there's a lot of burn, there's a lot of gestation period, and our return on investments can be hampered by direct or indirect competition coming from various fields, not just companies, but technology that will change any sector. We try to stay away from it because it's not worth taking the risk. Once we are cleared of the sector, then we go to the actual product or service that is being launched. Once we are sure that this has a use case, this has a market, this is scalable, this does not have a huge competition, so to say, in the near future. Then we go into deep diving, we go into team, we go into their ability to deliver, we go into valuations, we go into user acquisition strategies, we go into referrals, repeat customers, unit economics, etc., etc. So it's just a filtering process, and then if everything works out well, we obviously do the diligence that is required in legal, financial, technical, whatever the case may be. And that's how it works. That's how it grows.
Okay. So your first criteria is the sector, in terms of whether it's like a red ocean or a blue ocean, and then once you are at the broad, the sector level green ticks, then you get into the nitty-gritties like valuation and diligence, etc. So when it comes to valuations, sir, now one of the challenges that people face while valuing early stage startups, so I myself run a valuation practice, it is very difficult because there is a founder's bias towards everything being like $1 billion kind of a valuation because he's very, very optimistic about it. As an investor, you have to be fairly conservative in terms of being, I would rather say, realistic in your expectations. You have to get those expectations set right. So then, what is the that golden rule of thumb that you might be using? Or because a DCF, to an extent, I think in an early stage startup may not necessarily be the best method because someone can just project a lot of revenues and EBITDA in the projection. So then, what is your hypothesis for that?
So obviously, we don't use any formulas when it comes to valuation. There is no formula. Every sector has a different valuation at different times. It's a very dynamic valuation is not cannot be set as per formulas. It has to be very, very dynamic. It has to be very, very subject specific, sector specific, team specific, timing specific. So I think we don't apply any formulas. We when we come to valuing a early stage company, we kind of look at the competition, the possibility of scalability, the ease of scalability, the team's capability and ability. What have they put in so far? What stage have they reached, both in terms of technology and customer acquisition and cost of customer acquisition? The money that they need. We look at their cash flow requirements to scale up to 10x in the next 2 to 3 years, and then we kind of come up with a best case scenario. Obviously, nothing is right or wrong. We've had disagreements. We have people who agree to whatever but we try to follow a fair process where we don't dilute too much of an equity from the startups company. We don't want to dilute that. So I think it's a very, very dynamic subject. It's subject matter that does not have a fixed formula. I personally feel that it is going to need a lot of experience to decide what the right valuation should be.
And so, what has been the role of financial due diligence or a legal due diligence? And in your case, maybe a tech due diligence to understand really that technology, whether it's really worth it. So, and does due diligence sometimes be like a deal breaker as well? Does it raise red flags with respect to valuation? And so, what has been your experience around that whole piece of due diligence?
I think startups undermine the importance of due diligence. After a term sheet is given, when a due diligence happens, both financial and legal and technical, you have to understand that there can't be any red flags. The compliances have to be up to the mark. There can be no accounting systems that have not been followed, which are ethical and moral. Legally, also, you should be fully compliant if you're, every asset that you have, from IP to hardware to any codes, have to be very, very secure. Your data has to be very, very secure because the valuation is coming because of that. Your commitments outside of that startup should be disclosed. You can't have stakes, and you can't have other liabilities or assets outside of the startup that you're part of, without, and if there are early disclosure or first disclosures required. And similarly on technology, I mean, while we go by what one says in terms of claiming what the technology will be doing, but we go to customers, we experience the tech ourselves, we do the UI UX check, we probably do a backend check, we sign NDAs, so that they're not worried about their technology being taken away. And obviously, that is also required, because if technology is not worthy of being sold, it doesn't matter how good your team or idea or timing is. You really have to have a good tech to scale up. We don't give money for prototypes. We don't give money for proof of concepts that we assume should be in place. So I think all these have a very, very important role. We've had many situations where we had to reject companies after signing term sheets. Sometimes implications do come on valuations, and we have afterthoughts that we've given them too much value. The technology is not as good, or the financial assets or the legal assets are not as good. So we do go back. Sometimes the founders don't agree because now they've, committed to being a certain valuation, and the deals do break, and that's okay too, and that's fine, because everyone has the right of saying no to whatever they don't feel comfortable with, and that's how it works.
I mean, deals going off the track because of due diligence, that is something which a founder must be aware of. Because sometimes at the early stage, let's say we talk about compliance and they say, oh, we'll take care of it later. And then those kind of things eventually become conditions precedent to the term sheet, which they cannot fulfill and the deal falls off. So, so coming to my next bit, like you've written a check, the startup has taken it. But I think the real pain starts after that, because you have to actually handhold that startup and make it grow to that desired level of performance. So, what could be your mantra for monitoring investments? How do you really manage your portfolio? Do you have a team where you assign different companies to each of those analysts? And then what would be your secret sauce there for success?
So, when we invest in early stage companies and idea stage companies, it's very important that 0 to 1 journey is the most critical journey. So, I personally feel that monthly reports, quarterly reports, constant monitoring, being available to the co-founders to if they need us, helping them with market access, helping them with growth capital if they need, both in terms of equity and debt, if they're growing in the right direction, are very, very critical, because in the early stage, both selling the product or service and having stress-free cash flow are two most critical things. But all these are subject to them being amiable, them being understanding, and agreeing to our mentoring and handholding. Because if they're going off track and they're burning money left, right, center, there's nothing much we as investors or mentors can do. Sometimes co-founders or founders go off track and they think, no, sir, I can scale faster like this. Let me burn. And we can only tell them so much. We're a minority stake. So then we obviously don't involve ourselves into trying to go deeper and in a stage where they're not listening to us. So I think it's both ways. It has to work both ways. It has to happen in a way that works for both the startup and the investor.
So you had a fairly long storied stint in the world of investing. So if I were to ask, what have been your hits and misses, or like on a no-name basis, what could be like, that one iconic investment that you would really feel very proud of from within, and then one mistake where, that entire money went off.
Oh, there have been many. I mean, I think as investors, we are prone to making mistakes, and as a learning curve started some 13 years ago, we obviously had to make that journey. I've had many misses, and I'm not ashamed of naming Razorpay, Zostel. Both started off from Jaipur. They came to us. Razorpay, I was negotiating on valuation, and they went to Y Combinator. The valuation multiplied. We did not invest. Zostel, I thought Oyo would would any day want and go to the hostel sector. We did not invest, and those are mistakes that happened. Investments that I made that we scaled up, did well, and exits happened are obviously more than what the failures have been. There have been times where companies have been growing very well. We do a follow-on round, but just to give them a bridge round, and then they failed still. So I think it's just a matter of how much have you invested in the winning horses and how little have you invested in the losing horses is what makes your overall run rate better. And that's a judgment that prudence and experience will get you. Mistakes will happen in the same pro rata basis that it happens to anyone in any way, but it's just minimizing the losses and increasing the profits is what's more important. So I think that's something that's the difference between a good investor and a bad investor.
Hmm. Absolutely. So, sir, like, what would be your advice to those who want to invest in startups? I mean, is it everyone's cup of tea? It should be like a minimum net worth criteria. I mean, the regulators also are putting in some sort of criteria for AIF investments, but typically from a temperament perspective, from a risk appetite perspective, or a skill set perspective, what would be your advice to those who want to invest in startups? And once you've invested there, I mean, how does one choose the kind of funds? And maybe you could shed light on your latest offering that you've been now being offering to HNIs.
So obviously, if you are thinking of angel investing, one thing is for sure, you have to diversify your portfolio, sector-wise, stage-wise, amount-wise, and have at least 20 or some odd investments. Otherwise, it's not going to work your way. If you are wanting to angel invest, understanding different sectors, understanding the angel domain, understanding what valuations are, what is required to be seen, or piggyback riding on other people or other lead investors who've had experience to follow them are advised. If you don't have the time to look at the startup ecosystem, stay updated on technology and what's going on in the world, specific competition to the startups that you've invested, you're better off by investing at an angel fund or a Cat 1 VC fund. That way, experienced people regulated by SEBI will be managing your money. So I think all these three options, doing it yourselves, doing it with other senior investors as a consortium, or investing in funds are the three major options. Obviously, I can assure you, it might seem easy, it might seem lucrative, but it's not easy. I think understanding this domain needs a lot of experience, a lot of knowledge, a lot of learning, and it doesn't normally work, in my opinion, if someone is a novice or does not know anything.
Yeah, and so what has been like Swishin's offering that you'll roll out in that?
So we are doing a 20 million fund. We are looking at investing in early stage companies, same as I've been doing all my life. We're looking at majority of the money going into tier two, tier three towns. We feel we are very optimistic about the Bharat story, and we feel many products and services and companies are coming out of smaller, other than cities than Delhi, Bangalore, Bombay, etc. So we are very optimistic about that. We will be investing anywhere between 2 to 4 crores at the first instance, do about 30 odd investments, and then do a follow-on round to the rest. We've already started to take soft commitments, and we'll be raising starting end of the month or early February. So I think we are in a position where we can look at many investors partnering with us at this point of time, and I'll be happy to see growth in spread across India, not only in terms of startups that we will invest in, but as investors who will come from smaller towns, who want to understand the domain, who want to put 15-20% of their investment portfolio into the startup ecosystem, other than stock, golds, property, whatever else they're doing.
Makes sense. And I think it can be a great thing that with your kind of experience in the world of investment, someone who is not a nuanced investor rather than burning their fingers, they can actually get into mature people's company like your and then try that first stint with investing. Or maybe, at a later stage, people can always do direct investing, etc. Fair. Sir, your final piece of advice for someone watching this podcast.
Final piece of advice to startups, I think it's a very tough journey that you have embarked upon, but it's very exciting because times are changing. I think India has a huge potential as a market, whatever product or service you're doing. So whatever you do, if you do it well, if you do it in a planned manner, if you grow organically or exponentially, I think money should not be a problem. Organically will get you debt, exponentially will get you equity money. So I think being an entrepreneur is the thing to be in India rather than to be working for other people. As an investor, my piece of advice is start slow, but start because investments in startups with other people or in funds will give you much better IRR in the next 10 years than any other investment that you might ever think of. And I think it's an exciting journey. And you will soon realize that startups technology will be the future growth reason for growth for India's GDP. And India's state governments, India's government is very, very serious about all of this. So I think it should be a good opportunity for all of us to grow collectively.
Fantastic, sir. Thanks for your pearls of wisdom. And I'm sure people who watch this podcast can continue following you on LinkedIn and try to get some further wisdom out of your entire investing journey. And all the best for your fund launch. I'm sure it's going to be a super journey. Thank you, sir. Thanks once again for
Thank you.
spending time.
Thank you. Thank you.
Bye.
Cheers. Bye.